Yo, what's up, everyone? It's your boy Looney back with another real one. Today, we're breaking down something I get asked a lot, and that is, should I just run covered calls forever or complete the wheel strategy? And which one builds wealth faster? Let's get into it. Quick shout out to the Discord. It is free to join. And then if you want my real-time trades, full breakdowns, coaching, courses, links are in the description for premium memberships. So here's the question. When you're sitting on 100 shares of a stock, let's say, for example, SoFi or Riot, should you keep running covered calls or sell those shares after a run-up and just wait for a better re-entry? The answer isn't as simple as one size fits all, but here's how I think about it. Let me pull up SoFi, and I own around 400 shares. Really, it's 500 shares because I have a long leap call, but let's say 400, and it takes up 15% of my portfolio. Right now, I sell weekly or monthly calls. If I scroll down here, I have 4 covered calls at the 13 strike price, and I have a sell put and another covered call, like I said, for the long leap option. So even if the stock trades sideways, it's at $13 or slightly dips, that's actually what I would rather like, is it to fall below that $13. And if it does, I'm collecting premium, effectively reducing my cost basis. It doesn't show on here, but it effectively reduces the cost basis with those premiums, and it helps with stacking and compounding. Let me actually show you how it does reduce the cost basis. If I pull up options on Robinhood, and then you click on this realize profits, and right now I have it on my max, so like the max time frame. I believe this was started in 2024. But if we scroll to SoFi, I have 229 realized gains. This is from expiring options, even rolling. You can see all that is green, 229. And this is a relatively new position. So this is actually pretty small compared to others, like even NEO, Riot, Mara. So not only am I up on my shares, you could see here I'm up 16%. I'm up an additional $200 that they don't show on this position, which they shouldn't. They shouldn't show that gain because really I could use that money for anything. I could take it out of my account and spend it anywhere else. But there is an issue when it comes to covered calls, and it's called opportunity cost. So while I'm sitting on the sidelines just simply holding, I might be able to use this cash more efficiently. So if SoFi rips past my strike price, I might cap my gains. So if Riot or SoFi goes up to like $20, there's a chance of early assignment or just not the ability to sell the shares at a price I like. And I might have to close my covered call, and you have to pay for that. So I'd either be forced to buy back the call or lose my shares, like I said. And if I do lose them, what do I do with these shares? Should I get back into it, or should I just save up for a better entry? Now, that's where the wheel strategy does come in. You sell a put, you get assigned the stock, and then you run covered calls until you're called away. It's a full cycle. Now, this works beautiful when the stock's volatile, but trending up over time. Something like Riot. Let me pull up Riot. Even SoFi is a great example that I had, but Riot sort of trades sideways. 5 years, it is up significantly. It's because it changed what the company was, but even still, it has been slowly growing. And it has been slightly fluffed with crypto, but in general, this stock is moving sideways or slightly upwards. I have 800 shares. I'm still down on this position, down almost 10%, around that $9.26. And instead of just panic selling and just selling my shares at a loss, I have been selling covered calls to reduce that average like I went over on that SoFi position. But now Riot is in that $8 range. So here's the dilemma. Do I keep collecting $10 a week in calls, or do I sell the stock on a bounce and re-enter at a lower strike using puts? Now, I would say no. I would say rather just hold these and just keep selling covered calls until the stock is at a price that I'm comfortable selling at. And this is how I also look at if the stock is overvalued. Right now, the stock is not really overvalued. If we look at the RSI, it is actually slightly undervalued according to this on a yearly chart. Let me just go to it. It's right around the middle of the range, but I would say slightly undervalued. Year to date, it's a little bit higher. And on the 3 months, same thing. So it's sort of in the middle. It's at a perfect price range. And if you do believe it's going to pull back even more, the wheel strategy might be faster. So you take profits, you sell puts at a better strike price, and restart the cycle. If your stock is undervalued and you just want consistent cash flow, covered calls will compound slower but steady. And here's how I decide. Is the stock at resistance? So if it's trading at its higher Bollinger Band or just overall overvalued, it's actually a good time to let the shares go. Now, I don't feel like it's at that position. And the next thing is, what's my average cost? If it's too high, I do use covered calls to help lower it. But overall, I don't sell my shares until I am at least positive, but more along the lines of that 50 to 100% range is when I feel comfortable selling my shares. And the way I'm lowering my cost basis is selling more puts and collecting premium, and then selling even more puts to average down my cost basis, essentially doing a dollar cost average. Now, I also think about, do I have better opportunities elsewhere? So when Riot does go to a price range that is a lot higher, let's say like $15, it is not a bad idea to sell the shares and just have the cash aside and just wait for either Riot to have a better entry or another position at a better entry. And that's why diversification is huge, and it's smarter to just free up capital and redeploy. Now, you can't predict these things, so you don't know. Riot could go from $15 to $100, but at the same time, if it's at $15 and you made your money, you could sell them. And then if you see another stock is super undervalued, wouldn't be a bad idea to deploy some capital into that and even just leave cash on the side and just wait for a comfortable entry where you see the stock is just sort of consolidating. So in short, covered calls are slow, compounding, low maintenance, and I roll all the time with covered calls. And you can see I have a lot of those, and I actually rarely sell off my shares. I sell off my shares when I'm at that 100%, and it's slightly because of that opportunity cost. I don't want to miss out on those potential gains, but also I'm playing the long game. So if I prepare to own these stocks for a very long time. So I'm okay with the stock dipping a little bit. I'll just sell puts. And the wheel strategy does have a higher upside. You can catch these short trends. You could catch the bottoms, catch the tops, and it does help with long-term and entry management as well. But I like doing a little bit of both. I do the wheel strategy on all these stocks. NIO, I'm trying to actually get out of at that $4.05. If NIO does go to that $4.05, I'm very comfortable selling those shares because NIO doesn't really go above that 4.5. And if it does, it quickly comes back down. So that's an example of one that I would be okay with doing the wheel strategy and then just sitting on cash, maybe reinvest into NIO if it dips, or a better entry into another position, maybe a crypto, maybe another stock like Hood, but we'll see. Let me know in the comments which one you're doing right now. Are you holding, rolling, or flipping? Don't forget to like, subscribe, and hit the Discord link in the description if you want my real-time trades, course access, and more. Until next time, peace.